This week on the podcast, gifting. If it's on your mind, let's talk about some of the pros and cons. It's become a new trend to want to share the money with your heirs and loved ones before you pass on. So let's talk about some ways to do that where everybody gets a win in the situation. Let's get into it this week. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Welcome into Phil's Tax Hacks and Other Retirement Facts with Phil Putney and myself. And Phil, gifting is great, makes you feel good. Everybody loves to kind of, A, get a gift, and B, give a gift, right?
Yep.
And the gift of money is certainly one that we all appreciate. And I think, as I said in the teaser, over the last number of years, there seems to have been a trend pushing more towards, instead of the old way of, hey, we're going to build part of our legacy plan and our retirement strategy so that when, me and the loved one pass, the kids get a check, right?
Right.
And I think people now are like, wait a minute, the more through the last couple of years, like, why don't we spend some of this together while we're here?
Right.
So we can create memories, right? I think that's awesome.
Memories over money. So
yeah,
absolutely.
Are you seeing that trend?
Oh, absolutely.
Yeah.
Yeah. And I mean, I tend to agree with it. It's better to enjoy, and you get to experience that with the kids, create those memories, early on.
Yeah.
While you can, and then even like the grandkids, then they get to enjoy it too, versus, grandma and grandpa are gone now and we received X amount of money. And, that happens. Check. Yeah. Late, much later in life. And, your kids are now parents and maybe grandparents, themselves at that point. So, I mean, it's just a totally different scenario, not to say that that's wrong either, but it's, look at possibly bringing that forward.
Yeah, well, the legacy conversation always goes multiple ways, right? You got one party wants to leave everything they can. The other party says, no, they're not getting nothing or whatever. But, let's start with us in mind as the retiree, right? So there's nothing wrong with gifting. We're going to get into some numbers in a minute, kind of share some of the data. But I think you got to start with the fact of you got to have your retirement first, right?
Absolutely. So, I mean,
don't short yourself.
Yeah. Make sure that you're covered, so to speak, first. Run the math. Do you have enough so that you and your wife or, spouse, if you're married, can live comfortably through retirement to whatever your vision is? If you do, and there's potentially this legacy, then this is where that discussion can come into play to say, okay,
sure.
Based on the math, it looks like everything's going to be fine. You're going to end up leaving X amount in the end. Is that your goal? And oftentimes it's not, sometimes to your point, one of the spouses is like, oh, let's spend more, I'm going to die with zero.
That's right.
Which there's nothing wrong with that. You earned it, you saved.
I tease my daughter all the time. I'm like, I'm leaving you a credit card statement. I'm not leaving you a check.
That's right. That's right. Nothing wrong with that. I mean, you earned it. But what is your goal, right? I mean, if your goal is to end up leaving money at the end, or if you do have a surplus beyond what you comfortably need in retirement,
right.
Then maybe rather than leaving this big lump at the end, start planning in some vacations, or your kids go through different stages. They're buying their first house, or your grandkids are going to college. I mean, there's all these different
that kind of speaks to
lifetime, events that happen that rather than wait till way at the end, you can help out up front and change what their life then looks like early on.
Yeah, that speaks to the motivation, right? So start with the you, right? Yep. And I think the healthy approach that a lot of people have gotten to is if there's something left over, cool.
Right. And
they'll get it.
For most of my clients, because this is always a question that we have of, do you have any legacy goals?
Right.
And the 9 times out of 10, or probably more than that, 95% of the time, I would say it's like, hey, we don't plan. If there's anything left, great. So nothing wrong with that. Let's do it. Yeah.
But if you want to start doing more of that, hey, let's do some things together. What's the motivation, right? Is it to help them with the house? Is it to help them with an education or a life transition of some kind? Whatever the why is on what you want to give it to them. All right, now you need to understand the rules, Phil. So what's some of the interesting rules? What's some of the data? Because I love the fact that you can just gift a bunch of money to anybody. It doesn't even have to be a family member, right?
Right. Yeah. So, I mean, technically the rules today are an individual can give another individual up to $19,000 a year without triggering a gift tax filing. And this is always the kind of the catch in it. People think, oh, I'm going to have to pay a gift tax. So it's not a tax you're going to pay.
Okay. It's up to 19 grand.
Up to 19 grand a person. So if you go over that, then you have to file a gift tax return. All that is doing is just telling the IRS, hey, I gave more than what the limit was. I used up part of my lifetime, $15 million exclusion. So for most people, even if you go over this, it's not that big of a deal. You're using part of a lifetime exclusion that, 99% of the people are never going to get to anyway.
We're never going to hit it. Yeah.
Right. So, I mean, that is the rule. So, but it's 19,000 per person, so one individual to another individual. And that doesn't have to be blood, a child or, any relative. It can be anyone. So for a married couple, technically they can each give 19,000 to one child, right? So that could be 38. And this is in a calendar year. And this is for 2025. And
that's per recipient, right? So
this gets indexed each year, right? So now if the child is married, well, now technically you and your spouse can give 38,000 to each of them. So now
you can give it that's right. Okay. Yeah.
Now we're at, what is that? 76,000.
Yeah.
So when we start running the math with clients on this, they're like, whoa, that's way more than what I was thinking.
Well, yeah, I'm not giving them. Yeah, exactly. Yeah. I'm not giving them that much money. I like them. I don't like them that much.
Exactly. Yeah. So,
but you can, right? So that's the rule. So like, if you want to give your favorite podcast host, up to 19 grand, you can do that, so that's just, I'm just throwing that out there. But what about things like medical expenses, stuff like that? Can you gift in that regard? Can you pay a bill?
Right. So if the 19,000 is if you're giving direct, right? I'm writing a check to my child.
Okay.
Or it doesn't even have to be a check. I'm giving them whatever it is, right? I gave them a house. Yeah. I mean, whatever it happens to be, that is a gift. If you're not giving the money directly to them, but paying like a medical expense, college tuition, things like that, that doesn't count towards that limit because you haven't, and it's kind of funny. I mean, you haven't directly given it to them, but you paid on their behalf, but because it didn't go to them directly, then that doesn't count towards that 19,000.
Oh, okay. So you could $10,000 to the student loan and then $10,000 in cash if you wanted to.
Right. Yeah. If you're giving student loan, that's not one of the exceptions. I mean, you've got to be careful. There's certain exceptions.
Okay.
Right? There's like medical, tuition are the two main ones, that qualify.
I got you. So not the loan, but the tuition itself, right? Okay.
Correct. Right. So, a grandchild, I mean, if they're in school or even your child, right? If they're still in their master's program or PhD, whatever it is, if you want to pay that tuition, well, that's not a gift that counts towards this 19,000.
Gotcha. Okay. And of course you could always do the QCDs too, right?
Right. Well, yeah. So what we've been talking about so far is gifting to basically heirs, right? Kids. I mean, charity.
Or your podcast host.
Or your podcast host, right? An individual,
Right.
Gifting to charity. I mean, that's a whole nother discussion we can get into. But yeah, I mean, if you're over 70 and a half, and this is where kind of the QCD gets a little wonky, it's not RMD age, right? It was tied to RMD age back in the day when 70 and a half was the age. But in the QCD code section, rather than reference the RMD age, the required beginning date, so to speak, they referenced a specific age. So at 70 and a half, you can technically start giving out of your IRAs, your qualified money, to a charity, which is a great idea if charitable gifting is part of your scenario.
Okay.
So,
gotcha.
And another point kind of along that line, but back to the child. So, oftentimes I get a question, well, can I give $19,000 out of my IRA to my child? Absolutely. But you still pay the tax. Right?
I was going to say,
and that's the key, is that you can't give them 19,000 of your IRA and then they have to pay the tax. Not during your lifetime.
Yeah, and if
when
you're 50,
die, you can't.
You can't. And if you're 58, you're paying the tax and the penalty.
And the penalty, right? So gifting isn't one of the exceptions to the penalty for early distribution.
That's a great point.
Yeah, so you have to understand, where the money's coming from, right? I mean, this is from a tax filing standpoint, you don't have to file if it's under that 19. Now the mechanics of where the money comes from, you got to pay, again, back to the CPA hat, you got to pay attention to the whole tax side of it. And how does that look?
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of The Tax Smart Retiree right now.
Yeah. We had that question last week, and we were talking about special needs children. But just in the case of just giving money to your loved ones, I think a lot of times parents wind up going, we'll use the 2-kid scenario. You got one that's very, you got the good kid, and you got the one that gives you
has some challenges, right? Yeah,
right. So weigh that into it, right? Because you have one. Well, all right. I some friends of mine, they're twins, right? And they were left some money, and one was left some, and the other one had to wait. And they're like, "Why do I got to wait?" It's like, well, because you've been irresponsible, right? So just kind of weigh that stuff in there as well, because if one gets, the other's going to want. Especially if you got 2 kids, they're going to wonder why you got $19,000 over here and not $19,000 over here. Right. So just kind of factor all that stuff into.
Yeah, I mean, it brings up a funny story. I've got a client that has more than enough. I mean, they'll never overspend their money. And there's going to be significant money left to the kids. But that being said, he's helped the kids along the way, with down payments on houses and different things with businesses and whatever it happens to be. But he keeps a spreadsheet on the side to kind of account for that, saying, here's my accounting of, there's this, and, this child has gotten this. So I've got to make sure that, kind of in the end, we even all this out. Again, that comes back to you. What's your personality and, and your kids? I mean, if one gets something and the other one doesn't, or it's not exactly to the penny equal, is that going to create a rift? It's up to you how you want to handle that. But it's just one more scenario to consider in this is that, well, you're giving from the estate. And if you're giving to one person, and then you're still splitting the net at the end 50-50 for 2 kids, well, then you favored the one child. And is that fair? And do you need to, that's a whole nother discussion to get into.
Yeah, exactly. Well, at the end of the day, right, know the rules, understand your motivations and why, but make sure you're covering yourself first so that, you don't put yourself short. We all want to help our kids, as we talked about last episode, but, make sure that you're not sacrificing your own retirement to help them with some things, or at least within reason, right? So always talk with your CPA, talk with your qualified professional, talk with your financial advisor, and just get a plan in place. But it's good to know that it's there if you want to do some gifting. Lots of good options out there for those that are charitable minded.
As I say, have your plan up front, and then because you can't build all of these scenarios into a plan up front.
No.
These type of scenarios are things come up throughout life, right?
Yeah.
So you're 5-10 years into it, and your kids want to upgrade it to a different house and they need some help.
Yeah.
You didn't have that in the initial plan. That doesn't mean you can't do it. That's where your advisor comes into play. And I always, tell my clients, please just come to me with those questions versus making that decision on your own of, well, I did something. I always tell them, I would rather you come to me and say, I'm thinking about this versus I did this thing, right? And we're now having to make sure it works into your plan. So that's where a financial advisor can give big advantages to you in the comfort level of, you can do that. And it's not going to change retirement. You'll still have more than enough. You're going to have less at the end, but that's the decision. Do you give it now or do you give it later?
All right. Well, that's the gifting conversation. If you need to have it, make sure you reach out to your professional. If you need a professional, reach out to Phil. He's always here to help. You can check the show descriptions for links below and get yourself some time onto the calendar. Don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. Support the channel. We always appreciate that. And hopefully you pick up useful nuggets of information along the way. And we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.